Today I'm going to be sharing with you this amazing strategy of how you can use the fair value gap to increase the win probability of your trades. And also after applying this strategy, you will be able to increase the risk to reward ratio of your trades drastically. Now without any further ado, let's get into it. So first of all, let's talk about what is fair value gap. Fair value gap refers to the difference between the current value of an asset or currency and its fair value due to the inefficiency or imbalances in the market. Now what this means is sometimes the security is trading at a different price than what its fair value should be, and those are the prices or those are the times when fair value is created, and that gap is helpful in a lot of trading strategies as we're going to see next. So let me just go towards the chart and let me show you some of the fair value gaps that are created. So as I was just talking about, that when we see the market, it's always moving in either a bullish, bearish, or in a ranging market structure. Now as you can see here with this impulsive move, we can see that the market gave this very big impulsive move in the bearish direction, but right after the formation of this impulsive move in the bearish direction, the market went back in order to fulfill this zone or this gap that was created. But sometimes what happens is market does not come back in order to fulfill these gaps. For example, if we look here somewhere in the past, we can see that at this price here, the market did make this impulsive move, but it did not come back anywhere in future to fulfill this gap. So in future it will come back in order to fulfill this gap. As we can see here with this candle, formation of this candle, the market is filling this gap that was created, and market never came back in order to fulfill this gap. So with the formation of this candle in this region, we can see that the gap was fulfilled, and also with the formation of this bearish candle, the market fulfilled this gap. So until this gap is fulfilled, there is a trading opportunity that we can do. But before we do that, we have to specify, or we have to know how you can detect the fair value gaps in the market. And the way you detect the fair value gaps in the market is you have to look for impulsive moves in the bullish or bearish direction. For example, if we just go here, we can see that there are a lot of impulsive move in the bullish direction at this area here. Now whenever you see an impulsive candle, for example, you can see that this is an impulsive bullish candle forming, but with this impulsive bullish candle, there is also the previous candle is also making its wick somewhere here, and the next candle is also ranging at almost this range. So this would not be considered as a fair value gap because the market did not create a fair value, because the gap that was created with this candle got fulfilled by this candle, and then the gap that was created by this tiny little area here got fulfilled here. So this is not actually a fair value gap. So let me just show you what a fair value gap looks like on the chart. Now in this case here, you can see that the market gave this impulsive move in the bullish direction with this candle, and before this candle we can see that there is this tiny candle, and also this candle was not able to cover the whole body of this middle candle. So in this case here, there is a fair value gap that exists in the market, and this fair value gap would be drawn at the low of this next candle here and at the high of this previous candle here, and this area between these highs and lows would actually be a fair value gap, and market will come back in order to fulfill this fair value gap somewhere in the future. As we can see here, we can see the market came back in order to fulfill this gap in this area here. So if I have to specify the rules for detecting the fair value gaps, the first rule is that there should be a very big impulsive candle in the market, as you can see here. And the next rule is that the candle before and after this impulsive candle should not cover the body of this impulsive candle. As you can see here, this candle started from this area here and it closed here. So this is a very big impulsive bullish candle, and the body to wick ratio of this candle is above 70, which is also a rule for detecting the fair value gap. If its body to wick ratio is small and its wicks or shadows are very large, then we would not consider that candle as the fair value gap candle. So as I just said, the rules for detecting the fair value gap is that the body to wick ratio of this middle candle should be large, and also the candles before and after this candle should not cover the body of this middle candle. Now these are the rules for detecting the fair value gap, and the rule for drawing the fair value gap is actually the low of this candle, the next candle, and the high of this previous candle will act as our high and low of drawing the fair value gap zones, as we will see in our examples as well. Now that you know about what fair value gap is and how you can detect it on the chart, let's talk about its type. It has two types, in which the first type is underrated fair value gap, in which the current price of the market is below what it should be. So that would be underrated fair value gap, and in that case there should be a very big impulsive bearish candle, and the candles before and after that impulsive candle should not cover the body of that impulsive candle. So we can draw the fair value gap zone at the low of this previous candle and at the high of this next candle. So this zone here would be our underrated fair value gap zone, and in case of overrated fair value gap, this would mean that the security or a currency is trading at above its fair value. So which means that, as you can see here, with the formation of this impulsive bullish candle, the market is moving very impulsively or strongly in the bullish direction, and buyers are driving the market, and the candle before and after this bullish candle should not cover the body of this impulsive bullish candle, which is correct here. So we can draw the fair value gap zone below the low of this next candle and above the high of this previous candle. So this would be our overrated fair value gap, in which the security is trading, or current value of a security is greater than what its fair value gap is. So it would be trading somewhere in this region here, and with the overrated fair value gap, the market has to come back in future somewhere in order to fulfill this gap that is created here. And in this case here, with this underrated fair value gap, what this means is that security would be trading at some price below this zone. So because this is underrated fair value gap, the market will come back in order to balance this imbalance that has been created, since the security is trading below its fair value, or below its value which it should be. Now let's talk about the trading rules for taking long positions using the fair value gap. So there are multiple trading strategies that you can make with this fair value gap concept, because you can combine it with other indicators. For example, we can combine it with supply and demand zones, as we are going to do now. So for example, here you can see that there is a fair value gap created in the market, and we can draw the fair value gap zone at almost here. So if I just increase the opacity of this zone, so this is a fair value gap zone that has been created, and this is basically a overrated fair value gap, which means that the security is trading above this zone and its fair value is somewhere here in this region here. Now at this region here, we can see the formation of this supply zone, and with the formation of this rally based drop supply zone, the market made the supply zone here, and we can see that the orders got picked right away in the very next candle at this candle here. So at the close of this candle, this supply zone was formed. The way to trade supply and demand zones is that as soon as the supply zone is formed, we will place our order at the low of this zone, and we'll put our stop loss somewhere here. So our entry would be somewhere at this low of this zone, and our stop loss would be here. Now these orders got picked here. Now in order to take advantage of this fair value gap, we can set our take profit level at the high of this fair value gap zone, which you can see it got fulfilled. And as you can see here, our take profit level was here, so we were able to take a trade of 6.49 risk to our ratio, which is phenomenal. Now this concept is very unique because it gives you a lot of trading opportunities, and using this concept you can set target levels or take profit levels for your trading strategies, as I just did now for this supply zone. By the way, in order to detect supply and demand zones automatically on your chart, you can also use our supply and demand indicator, which will help you identify and show you in real time what supply and demand zones are forming. So you can just go towards the charts and trade those zones. So with this strategy, we were able to take a 6.5 risk to our ratio trade using this fair value gap and using the supply zone strategy. Now let me just go ahead and show you how you can also use this fair value gap on its own, but it is not actually on its own. You'll be using this fair value gap with some other indicator or some other candlestick pattern. For example, as you can see here, there is the formation of this fair value gap. So if I just go ahead and draw the fair value gap at this zone here, we can draw our fair value gap somewhere around here. Now there is the body of this candle is being covered by this bearish candle, but this candle is so small that we can ignore it. So we can draw our fair value gap zone at the high of this candle here, and we can put our zone high at the low of this candle here. Now we can extend this in future, and as you see, we are seeing the formation of this bullish pin bar at this candle here, or this candle here. And during this candle, the market came back. First of all, after the formation of this overrated fair value gap, the market gave this impulsive move in the bullish direction, then it comes back, and with the formation of this pin bar, we can see that this is a bullish pin bar. So this long shadow shows us the price rejection by the buyers. So buyers are very strong and they're driving the market in the bullish direction. And also at this candle here, we can see another fair value gap that is forming. So for example, if I just go ahead and draw this underrated fair value gap zone here, we can see that with this fair value gap, we were able to take our entry at the high of this candle here, at the close of this candle here. So we can just go ahead and put our entry at this candle here, and we could put our stop loss at the low of this bullish pin bar, and we can set our target to be the low of this underrated fair value gap, so which gets fulfilled here. So we are able to take this trade because of two fair value gaps combined, and this was a very good trade setup that allowed us to take 2.5 risk to our ratio. I hope you understood how we took this trade. We used this fair value gap zone in order to take our trade, and we used this underrated fair value gap zone to set our take profit level. Now these are the ways you can trade the fair value gap zones, and this is how you can detect the fair value gaps. I hope you like this video. If you have any questions, please comment down below. I would love to answer them. Also, don't forget to like, share, and subscribe. See you guys in the next video. Thank you.